Welcome to the Authority Hub podcast. I'm Nolan, joined as always by Claire.
And today we're featuring the expertise of Steve Dainard, mortgage broker in Niagara Falls, Fort Erie, on
Your mortgage is renewing in 2026. Your financial picture has shifted since you first signed, and the bank that approved you 5 years ago is now telling you the numbers don't work. What do you actually do next?
That is the question sitting in front of a lot of Niagara homeowners right now, and it is not hypothetical.
It really isn't. Let's talk about a specific kind of client who ends up in Steve Dainard's office.
Set it up.
A self-employed contractor in Fort Erie, solid business, consistent work, pays his bills, but when his mortgage comes up for renewal, the bank runs his T1 general and the qualifying income just doesn't get him there.
Because the income that looks great in his bank account looks very different on paper after legitimate business deductions.
Exactly. And this is not a story about someone who made bad decisions. This is a documentation gap, not a financial reality gap.
That distinction is one Steve Dainard comes back to repeatedly when he talks about this space.
So the borrower goes to the bank says no, and then what? Because a lot of people in Niagara Falls and Fort Erie stop there and assume that's the end of the road.
And that's where the system fails them, not because the bank did anything wrong, but because the bank's model is not built for complexity.
Walk me through that.
Traditional lenders operate within tight federal guidelines. They need consistent, documentable income, strong credit scores, and files that fit cleanly into their approval framework.
And when a file doesn't fit that framework, self-employment income, a period of bruised credit, a life event that left marks, the answer is no.
And that no is not a judgment on the borrower's actual financial position. It's a reflection of the bank's internal criteria.
Which is a structural problem, not a personal one.
Right. And the borrowers who get hurt are the ones who take that no as a final answer when it isn't.
So this is where Steve Dainard's work in the Niagara region becomes genuinely consequential.
Because Steve Dainard operates in a lending category that sits between traditional bank mortgages and private loans, what's called alternative mortgage financing.
And that category is not what most people think it is.
The biggest misconception Steve Dainard addresses directly is that alternative financing is the same as a private mortgage. It is not.
That distinction matters enormously for a borrower trying to understand their options.
Alternative lenders, B lenders, trust companies, are regulated institutional lenders. They have defined underwriting criteria, formal approval processes, oversight. They are not informal arrangements.
They just have qualifying criteria that are built to accommodate more complexity than a standard bank model allows.
And in Canada, alternative lenders collectively fund billions of dollars in mortgages annually. This is a mainstream lending category.
So when Steve Dainard is working with a self-employed borrower in Niagara Falls who got a no from their bank, the conversation shifts to what an alternative lender actually looks at.
And the answer is the full picture, the property, the equity position, the borrower's trajectory, the story behind the numbers.
Not just the T1 general.
Some alternative lenders offer stated income programs where the borrower declares income and the lender assesses it against the reasonableness of the business type and industry.
Which opens a path that the bank's model closes entirely.
The equity requirement is higher in those programs, but for a self-employed borrower with a solid business and a documentation gap, that trade-off often makes sense.
Let's talk about equity specifically, because Steve Dainard is pretty direct about this being the central variable in most alternative mortgage decisions.
More so than credit score or income alone. A borrower with meaningful equity gives an alternative lender a concrete basis for their risk assessment even when the income picture or credit history is complicated.
And in the Niagara Falls and Fort Erie market, that equity calculation has a specific wrinkle.
Lower property values in this market mean lower absolute dollar amounts available to borrow against, even when the percentage-based lending limit stays the same.
So a borrower who estimated their equity position based on a valuation from a year or two ago may be working with less room than they think.
Which is exactly why Steve Dainard works through that equity math early in the conversation, before a file ever reaches a lender.
Because pursuing a path the numbers won't support is a waste of time the borrower doesn't have.
Especially with a 2026 renewal date on the calendar.
Let's bring in the credit piece because that's the second major group Steve Dainard works with in the Niagara region.
Borrowers with bruised credit. A job loss, a health event, a business downturn, a relationship breakdown. Any of those can leave marks on a credit report that persist long after the underlying situation has resolved.
And a borrower who has genuinely stabilized their finances but is still carrying the credit history of a harder period will find that mainstream lenders are not yet ready for them,
even when the current picture is solid.
What Steve Dainard does in that situation is work through the credit narrative with the borrower before the file goes anywhere near a lender.
Because alternative lenders look at the pattern behind the credit history, not just the score. A single difficult period followed by clean payment history reads very differently than an ongoing pattern.
And a broker who can frame that file accurately makes a real difference in how the lender interprets what they see.
That's the practical value of working with someone like Steve Dainard, who has direct access to multiple alternative lenders, not just a single channel.
Because the structure of the file and how it's presented affects the outcome.
A poorly structured or incomplete file will not perform better with an alternative lender than it did with a bank. Alternative lenders are still selective. They decline files that don't meet their criteria.
They just have criteria that accommodate more complexity.
Exactly. The difference is not that they have no standards, it's that their standards are built for situations that require a more complete read of the file.
Okay, so let's say a borrower in Fort Erie works with Steve Dainard. The file gets structured properly, and they get approved through an alternative lender. What does that actually look like?
It looks like a short-term mortgage, typically 1 to 2 years, and that shorter term is intentional.
Because the alternative mortgage is not the destination, it's the bridge.
The purpose of the term is to create a defined window during which the borrower addresses whatever gap prevented them from qualifying with a mainstream lender in the first place.
And Steve Dainard is very direct about this. An alternative mortgage with a clear exit plan is a tool. The same mortgage without a plan is a deferred problem.
That exit strategy conversation happens at the start of the term, not at the end. What needs to change, by how much, by when?
For a self-employed borrower, that usually means building a documented record of filed tax returns showing consistent income at a level that supports the mortgage.
For a borrower with bruised credit, it means every payment during the alternative term, mortgage, credit cards, car loans, is on time. Rebuilding a clean payment pattern.
And for both groups, debt service ratios are the variable that borrowers often underestimate.
Mainstream lenders calculate gross debt service and total debt service ratios against gross income. Carrying high consumer debt alongside a mortgage can push those ratios above the threshold even when income and credit are otherwise solid.
So reducing consumer debt during the alternative term directly improves the numbers a mainstream lender will calculate at renewal.
Steve Dainard maps those ratio targets out with clients in the Niagara region at the start of the alternative term, so the path to mainstream qualification is clear before the clock starts running.
That's the difference between a borrower who arrives at renewal ready to have a genuine conversation with a mainstream lender and one who ends up in a second alternative term.
Which is a more expensive outcome than the first, because the costs of alternative lending are higher than mainstream lending. That's a structural reality of the additional risk the lender is taking on.
And Steve Dainard is straightforward about that. The costs make sense as a bridge. They're harder to justify as a long-term arrangement.
The relevant question is not whether the costs are higher, but whether the total cost of the alternative mortgage over its term is less than the cost of the alternative, not accessing equity, not completing a purchase, carrying higher cost consumer debt that the mortgage would consolidate.
For most borrowers in a genuine qualifying gap, that math works in favor of the structured solution.
And that's the conversation Steve Dainard has with clients across Niagara Falls and Fort Erie before anything gets submitted to a lender.
Let's come back to that contractor in Fort Erie we opened with. He works with Steve Dainard, the file gets structured with the right alternative lender, and he gets a 1-year term.
During that year, he works with his accountant to make sure his income is being reported in a way that reflects the actual strength of the business. He keeps every payment clean. He pays down consumer debt.
And at the end of that term, the qualifying income is there, the credit pattern is clean, and the debt service ratios are in range.
The file that was a no at the bank 12 months ago is now a yes.
The family stays in the home. The renewal happens. The number stops being a barrier.
That's what Steve Dainard's work in the Niagara region actually produces. Not just a mortgage approval, but a structured path back to mainstream financing.
And that's the thing worth holding onto from this conversation. Alternative mortgage financing is not a last resort, and it is not a penalty category. It is a structured solution for real situations that mainstream lenders are not set up to handle.
If you're a homeowner in Niagara Falls or Fort Erie staring down a 2026 renewal, or you're self-employed and the bank keeps saying your income doesn't qualify, the earlier you start that conversation with Steve Dainard, the more options are on the table.
You can find Steve Dainard at themortgageguyniagara.com. Steve Dainard is a mortgage broker in Niagara Falls, Fort Erie, specializing in alternative mortgage financing.